Going to get started here on lesson 3, the introduction to real estate investing. And I think what I want to do is just frame the importance of this lesson, focusing on the entity structure, which we're going to cover and go back and do a little bit of review. And then the 3 metric of measures that we're going to do a review on case study number 1. We've got a couple of case studies during this course, and this is our first case study that we're going to be looking at. This is an actual real estate deal, Mohawk Investments, and we're going to take us through the purchase and holding period of 5-year holding period and look at the 3 areas of measure other than the financial metrics that we normally measure in investment real estate. These are the areas that we're looking at that give us some insight into some of the significant value propositions that we have opportunities for in real estate investing. And I'm going to tell you that most experts are of the same opinion that I am, and that is multifamily real estate investing is going to be an explosive sector for the next foreseeable future. That's at least 8 to 10 years going forward. There is such a shortage in housing, and anything that you can do to get into multifamily is probably, you'd have to work hard to lose money at it. So with that said, let's dive in and look at sort of an overview. We want to look at the entity structure because most importantly in this process, the most significant part of a challenge in real estate investing is how you invest in the real estate decides how you get taxed in the real estate. And I have yet to see an investor in real estate where I've looked at it for the first time and they're set up in the most optimal or tax-centric way that gives them the most advantage. There's always some issue that needs to be refined or adjusted or reorganized to give them a more tax-centric approach to their real estate investment. You've got the tax treatment and you've got the financial treatment. And so you've got to balance one against the other in terms of what you're doing in the investment. And it all comes down to how that investment is structured to begin with. So we're gonna do a little bit of a review from a prior lesson. We're gonna have the overview of the entity structure, the purchase and negotiation of case study 1, the summary of the analysis, the financial metrics and management structure and how that works. Mohawk Investments is a property that we purchased 5 years ago. We're in our 5th year of holding on this property. And you're going to learn some new techniques about rent surveys, and how to calculate your actual cost and how to calculate your actual rents if you want to stay ahead of the curve and ahead of the inflation curve especially. So with that said, let's kind of go into the next part of this. The entity structure that we're going to suggest and that you consider and that we do a lot of work in is what we call a corporate management conduit, where we have a corporation set up. You own the shares of the corporation, and then we set up a limited liability company, holding company, managed member, LLC, where you, the individual, and the corporation are managing members of the LLC. The corporation is a 10% owner, for example, and you're a 90% owner, but the corporation gets 90% of the profits and losses and distributions through a K-1 that goes up to the corporation. And that's the uniqueness of the limited liability company. You can disproportionately allocate profits and losses to the individual or to the corporation. With more than one property, we want to consider also making a grouping election under 469. The grouping election allows you to group all of the activity as a single economic unit for tax reporting purposes, because then you only have to meet one of the tests in connection with the hours test or the material participation test. And so the impact of a grouping election under 469 is a very important play. That has a big impact on passive loss limitations because you're no longer subject to those passive loss limitations. So again, we can look at the different ways that we can own real estate or different entity structures: an individual investor, a married couple that would be a marital joint venture, single member LLC, a managed member LLC, C corporation, S corporation, general partnership, and limited partnership. Again, our best advice in almost every case is that we set up a corporation management conduit and an LLC holding company that is a managed member LLC. The corporation and you become the managing members. You have 90% of the interest in the LLC. The corporation has 10% of the interest in the LLC, but the corporation gets 90% of the profits and the losses because of the disproportionality allocation that an LLC can make. This allows you to do some advanced tax planning, both now and in the years ahead, particularly as you'll find next week when we do case study 2, how to avoid the capital gains on a $700,000 profit because you had this set up. And we're going to study that next week on lesson 4 in case study 2. So moving along, the basic entity organizational structure is a basic corporation. Generally, it remains a C corporation, and the LLC remains a managed member LLC. Corporations have a life in perpetuity. LLCs have a fixed life. So you have to be a little bit cautious to make sure that your LLC is given enough life. Usually 15 to 20 years is sufficient, but you got to remember that, it does have a fixed life, unlike a corporation that lives in perpetuity. Now, with that structure, you have the opportunity now to maximize, from a tax-centric standpoint, all of the tax advantages, both today and in the years ahead during your holding period, particularly if you're concerned about having to pay large taxes on capital gains in the future. You're going to want to look at a couple of ways to do this so that you can navigate around and avoid those large capital gains. This is one of the reasons why people go into a 1031 tax deferred exchange, is because they're top heavy on the gain exposure and they have very little choice but to do a 1031. Otherwise, they're going to give up more than half of their profit in taxes. And if you're in a state like California, the Socialist Republic of California, you're going to give up about 63% of your profit between state and federal taxes. And that's why people are doing the 1031s, because it doesn't make sense to sell it when you're going to give most of it away in tax. So we're going to do a study of some data on Mohawk Investment. It's now in its 5-year holding period. And the first column of numbers is what the result would be if we had done no planning. And the second column is the result we would have because we did some planning. The property was a 4-unit/5-unit. It's now a 5-unit. property, and it was listed by a retired real estate broker for 1.1 million. We paid 979,000. And if we had done nothing except just buy it, we would have a purchase price of 979. Allocation for land was 250,000. Take 979 minus the 250. The building improvements was 729. And if you divide that over the 27.5 year, forgive me for putting that on the wrong line, you would get 26,509 a year in depreciation. It should be actually, yeah, that is 27.5 year. That's the deduction by taking 729 right here, dividing it by 27.5 year. That's the deduction per year. And assuming a top tax bracket, the tax savings would be $10,000, almost $500 after a 5-year holding period. You'd have 52,000 and change in tax savings. You'd have an appreciated value today of $1,679,000. You would have basically no cash flow from rent by square foot increase because that wasn't done as part of the plan. Your appreciated value would leave you about $700,000 in equity, but that would be diluted because you wouldn't get the same cap rate because you haven't done the other factors that we'll discuss in this example. And so at the end of the day, and I'll show you the comparative difference on those two, it makes a big difference. Taking some planning approaches, starting with the entity structure. This is held by a managed member LLC, Mohawk Investments LLC. The owners of the LLC are my wife, Susan, and I, and the corporation, which is a managing member, Conduit Corporation. We still paid $979, $250 for the land, $729 for the building. But of the $250 of land, we had $150,000 of improvements on the land. Sidewalks, driveways, fences, irrigation, plumbing, laundry room, all of those different things were basically about $150,000. So that raw land portion is only $100,000. We can't deduct that. Then we took a cost segregation study and we said, okay, how much of all of the building is 5-year assets? How much of the building is 7-year assets? How much of the building is 15-year assets? And whatever's left over is the residual to 27.5 year. And then 15-year land improvements, they get depreciated over 15 years. So we can see the total depreciation right here for those different asset groups of the building of 729. And this column right over here tells us each year how much we're going to deduct. So now instead of getting $26,509 in depreciation deduction here, we get $72,495 in depreciation per year over here. When we take the total depreciation of $72,495 rounded up per year, the annual tax savings instead of $10,497 is $28,707. So the tax savings over 5 years, we've saved $143,539 in taxes, which is 173.5% more than we would have got by doing no planning. We take the tax savings of $143,539. We add the cash flow from the rent increase by using a square foot increase methodology in a rent survey on the rents. And we were able to bank over 5 years an additional $109,000 in cash that we're still sitting on in T-bills. And the appreciated value, the property today would sell for $1,679,000. So we've got 700,000 in adjusted equity with no dilution because we've done the cap rate on the rents and we get a high cap rate. So our benefit in value, in tax benefit and appreciated value after 5-year holding period is 952,539 against a purchase price of 979. So the building properties only cost us in 5 years $26,460. I will do that all day long and make that kind of return on my investment. And if and when we sell this property, we're actually going to have no taxable gain because we have a corporation set up where we will absorb the gain in the corporation through other tax planning strategies. So we will pay no tax on a capital gain on a disposition of this property, not having to be forced into a 1031 tax deferred exchange. So the three components that we want to measure in setting up our plan are the tax savings, the increased cash flow using a rent survey square foot analysis model, not rent comps. That if you do rent comps, you're going to lose money. You're just going to lose money faster than the guy down the street or the gal across the road. And you want to measure your appreciated value, your market comp value, based on not only market comps, but your cap rate on your rent surveys, which we'll get into in lesson 4 next week in case study number 2. And this gives us the most advantageous tax-centric approach. Literally, this property will sell in a couple of years for over $2 million, and we will have no taxable gain. And we'll take that $2 million and parlay that into a 7 to 8 unit property and start the process all over again. Now, I want to show you that in terms of the 3 different models that we're trying to look at, and let me just bring up, hold on just a second, see if I can bring up this other version here on the spreadsheet. In terms of the models that we're looking at, what we're trying to do is we're trying to figure out what is the sweet spot in terms of the amount of rent or the amount of appreciated value or the amount of cash flow that we're going to get, and how much of the tax savings are we going to be able to generate. So for tax savings, there's 3 things that we will set up that are tax centric as part of this plan. Number 1, the cost segregation study. Number 2, the depreciation modeling. And number 3, the management fee from the LLC to the corporation. So let's talk about the cost segregation study. We have an engineering company called CSSI that does all of our cost segregation studies nationwide. And they come in and they take the property and they divide it into these different asset groups. So we're taking the building of 729,000 and we're subdividing it into taxable groups, 5-year, 7-year, 15-year, 27.5-year. And then land improvements are 15-year. And we are taking the straight line depreciation methodology, because when you do straight line depreciation method, when you sell the property in the future, it's not subject to recapture. You don't have to add back the depreciation to your capital gain and pay ordinary tax on the depreciation under the tax benefit rule. If you're depreciating the asset, you have to recapture that depreciation unless you're using straight line depreciation. Straight line depreciation is an exception to the rule of recapture, in which case we don't have to recapture. And look what I'm getting. I'm getting 3x more per year in depreciation for the same asset. I'm just modeling it in a different way. If I did nothing, I get 26,509 annual depreciation. That saves me 10,000, roughly 10,500. If I model it and I do the cost segregation study, I'm getting 72,495, rounding it up, and my tax savings is 28,707 per year. That's 173.5% more in tax savings doing the cost segregation approach, and that does not count the tax savings that I'm going to save when we sell the property, and I don't have to recapture all that depreciation and pay ordinary tax rates on it. Ordinary tax means it's going to be taxed at least at 28% or higher when you sell it, because tax rates are not going to go down, they're going to continue to go up. And so if we look at the long-term holding proposition and the planning, we're going to be able to keep more of the money today, and we're going to be able to keep more of the money tomorrow simply by setting up this strategy and setting up this plan in how you're going to be holding the asset. So that takes care of the cost segregation study and the depreciation modeling. Now the management fee from the LLC to the corporation. The corporation is a managing member along with you, or you and your spouse, as members of the LLC. But you have a management agreement between the LLC and the corporation, so that the LLC that collects the rents is paying basically a management fee every month or every quarter to the corporation, so that the LLC, when it files a partnership tax return, it has no taxable income. All that money is going up, 90% of the profits and losses in management fees, to the corporation. We're taking the corporation, when that money's coming up to the corporation, and we're either reinvesting it, or we're taking salary and retirement benefits and deducting it there, which we'll learn in lesson 4 next week on how to set up defined benefit planning, and then use your defined benefit plan to buy your next real estate deal. And then have that set up so part of your retirement planning could be a self-directed Roth, owning the real estate that you're investing in. So the management fee conduit sets up the entire planning model to allow you to do the real estate in a much more tax-centric and much more financially centric approach by modeling and setting up the plan. And even if you've owned the property for 4 or 5, maybe 6 or 7 years, you actually can go back and retroactively do the cost segregation study and reset those numbers and implement this kind of a plan without having too many challenges or issues to be able to do that. All right, so that takes care of the 3 pillars to the tax savings model. Now, there are other attributes of tax savings that we'll learn in lesson 4 and 5, but these are the 3 basic: the cost segregation, the depreciation, and the management fee. We'll learn in lesson 4 next week on case study number 2. There are some additional things that we want to look at in tax attributes and tax savings that are more long-range planning. How do we increase the cash flow? Well, one approach is to raise the rents, but often what I hear from investors is, well, I don't want to raise the rents because I've got good clients and I don't want them to move. And while your heart's in the right place, your mind has gone off the rails. You've got to be crazy. You can't do that. This is an investment. The purpose of your holding real estate, you got to understand and define what the purpose is. Is your purpose to own real estate for income, for appreciated value? I mean, you've got about 5 principal objectives for owning investment real estate. What is the purpose of this property? What's its investment purpose? And in particular, whether it's appreciated value or income, not raising rents is kind of counterintuitive to that objective and antithetical to making a profit. most people that are invested in real estate is small investors like ourselves. What they traditionally will do is they'll look in the paper or they'll look in line to some of these like apartment.com or other, resources, and they'll do a loosely defined comparative rent analysis. You've got a 2-bedroom, 1-bath, 850 square feet. And so you look down the road and there's one in your neighborhood that's renting for, $1,900. So you're going to rent yours for $1,700. I don't know. I see a lot of that kind of analysis, loosely defined. And while that is certainly one way to do it, that is one way to do it and lose money really fast, and over time lose a lot of money really fast. The rules in California, depending on when you own the property, the age of the property, may or may not be subject to these crazy socialist rules that we've got about rent caps and rent control. The general rule for any property in the state is that you cannot raise your rents more than 10% a year, which is the base of inflation plus or minus 4%. It cannot exceed 10%. Some areas and counties, San Diego County that we live in is not one of these counties, but some of the counties are more restrictive, like San Francisco, where they actually have radical socialist rent control initiatives. There are lawsuits working their way through federal court right now that actually represents a taking of property. I'm sure it'll get in front of the Supreme Court at some point. Those will be struck down as unconstitutional taking of property. But suffice it to say, we live in that environment right now. I am not a fan of rent comps. They're unreliable, and it's a race to the bottom. Jane is competing with Joe, so she wants to get the tenant, so she's going to be $100 a month cheaper than Joe, and Joe's thinking, well, Jane's doing that, so I'm going to be cheaper than Jane, and so he tries to go 100 below, and it's a race to the bottom. And there's no rational basis for how you came up with that rent other than that's what everybody else seems to be charging. That is certainly an approach, but I can tell you it is outdated. It has been outdated for at least 10 years, and it's not working. And all of the investor clients that I work with don't do that. Many of them have advanced forward now and are using a very, very efficient rent survey modeling, where we actually do valuation surveys on the rents, and we do this costing analysis so that we can give them those results. And the basic way that it works is we take the total cost of the property. These are all of your costs: your insurance, your property tax, your mortgage interest, your repairs, your fixed amortization, your depreciation. We take all of the costs, your management cost, your time. We analyze all of these costs, and then we divide it by the rentable square footage of the building's total square foot. Whether you have 4 units, 8 units, maybe it's a single family, it doesn't matter. Single families are notoriously bad investments for rental property because you have a lot of tax traps that are inherently very negative in the disposition of a single family, and you've got to do some additional advanced planning to avoid those tax traps. But for the purpose of this lesson, let's just stick on the multifamily. We take all of those costs, and then we figure out what portion of them are fixed cost and what portion of them are variable. And to the extent that we have variable, we want to know what the percentage of variable costs are, represented as a percentage of the total cost, because that tells us something about our inflation index. And if we don't understand how much our costs are rising in terms of real inflationary impact, then we're likely to lose money and not even know it. And then you sell the property, and then you wonder why. Well, I got 400,000, but I don't have any money left. And this is why, because we don't have, it's leaked out through all of these different what we call investment holes, and we got to plug a lot of these up. So we do that cost analysis on the square foot basis. We want the fixed and variable. We want to identify those. And we do the rent analysis on the same square footage basis. How much rentable space do you have that a person is renting? What are the amenities? Now, Susan and I have taken the approach, and we've had this approach for many years because we own a lot of property. We give the tenants one price, and that's the price. And it covers everything. It covers the rent, it covers cable, it covers gas, lights, water, sewer, trash. And we tell the tenants, now look, if you keep the utility cost down and in a reasonable realm, when we talk about rent increases next year, maybe it's not going to be as much as it would otherwise be if you're not paying attention to leaving the lights on all the time. And as it turned out on this particular property, the first year we implemented that, our utility cost over the year for all 5 units went down 23%. It was just amazing how it worked. So the younger folks, the younger generation, they don't want to hassle with setting up rent and deposits and then utility deposits, turn on this, turn on that, turn off this. We just decided, look, we get a premium. We get about 18 to 20% more in our rent than anybody in that zip code, 92115, because we give them one price and it covers everything. And then they don't have to worry about all of the inconvenience of setting all of that stuff up. And per square foot, we're getting about 2.3 to 2.6 times our cost in rent per square foot. So if it's costing us $1.05, we're getting about $2.40 to $2.60 a square foot. And not only are we servicing the little bit of debt that we have left, but we've got strong cash flow and a high cap rate that gives us roughly about an annual return of about 19% on our investment per year. And we've built up over, right now, I think over $130,000 in cash reserves just by taking that difference and investing it, and then retiring. Each year we retire about 15% of the balance of the mortgage that we had. And so that mortgage, by paying it off, accelerating the principal, at the end of next year, we will have the mortgage paid off completely with no debt, and all of that income up about 50% of what we bought it from. This approach gives you such a powerful increase in cash flow, and it turns your investment into, it gives you a valuation that is probably, this property without this analysis would sell for maybe 10 or 12x gross rent. Because of what we've done, we'll get a premium and we can sell it for 20x of gross rent. If we had not done all of these things, it would come in at a valuation of about $1.2 million. But because we've done these things, it's coming in close to about almost $1.7 million. That's a $500,000 increase in value because of what we've done and how we've set it up. And it is really a very, very tax efficient and financially efficient investment vehicle. You set those up and have that surplus cash go into your reserve accounts, and every quarter or every month or every half a year, you retire a portion of your principal on the mortgage with your excess cash reserves. You're building equity and value, and we raise the rents between 8 to 9% per year. If I do 9% in 5 years, I've raised the rents over 50% in 5 years because it compounds. I've got a 50% increase in my gross rents. If my gross rents started out at 80,000 5 years ago, and today they're 130,000, it's actually 60% increase in rents. My costs have stayed pretty much even or neutral to inflation. And so my cash reserves are accelerating each year. They're growing by 20%. And I'm building a cash machine that in 2 more years will have a property worth $2 million with 200,000 in cash. I'll be able to take that into a 7 to 8 unit building for cash, and I won't have any debt. And then I'll get 2 times the annual increase in income, all because we set the plan up of how we're going to hold the property and how we're going to dispose of the property and how we're going to approach the property in terms of our cost analysis, fixed and variable cost, per square footage analysis. We're not going to do rent comps. We're going to do rent surveys, and we're actually going to treat it like an investment because this is our retirement plan. Owning as much real estate as possible is part of our retirement plan. Appreciated value are subject to market conditions and market comps. San Diego, this particular zip code, annual appreciated value, if we did nothing, is about 12% a year because it's in an area next to San Diego State University. It's a high demand, high density, and virtually zero vacancy rate. Because of the population of the students at San Diego State. If you can get next to a military base, you can get next to a university. Those are preferred because those population groups are only going to grow in demographic profiling. Nurses or traveling nurses, military, E6 and above, or students that are in their third to fourth year, or grad students are the 3 best tenants you could possibly ever want or have. You're never going to lose money in real estate. So understanding your market conditions and your market comps, but also the subject property versus the market. Don't look at appraised value. Look at a valuation study, because it's going to unlock the hidden value of your property. We do valuation studies on rental properties, which are very different than doing an appraisal. I'm going to tell you what the economic value of the property really is with a valuation study. What you decide to sell it for, you can actually get a premium on the sales price. This particular property would normally sell for 11 to 13 times gross rents if we had done none of this structuring. But because we've set it up and structured it that way, we're going to get close to 20x gross rents. And we're not going to sell the property. We're going to sell the shares of the corporation or the shares of the LLC that owns the property. That's a very different transaction. That's not an asset sale. That's a stock sale. And so you're going to be able to get a premium on the valuation modeling. And we're going to see more and more of this shift in investment property, particularly multifamily investment. The trends have already started. They started about 7 or 8 years ago, and they are accelerating now that we're past this nonsense with COVID. Property enhancements fall into repair or improvement, and you want to make sure that you're leveraging these. We'll talk about that in lesson 4 and 5, because those are going to give you a significant value upside if they're set up the right way. In other words, for every dollar that I put into this property that's an enhancement, I'm getting $1.70 to $2.50 in appreciated value, because it's enhancing either its cost factor or its rent factor. We took some spare space that was available. We created 2 storage spaces. It has 2 garages under the studio, and we rent those garages out, and we rent those 2 storage spaces out for $1.75 a square foot. So we're getting, and we converted the laundry room from a 1 washer and dryer to 3 washers and 3 dryers. So it's producing, instead of $40 a month, it's producing about $150 a month in income off of the washers and dryers. And we're getting about another $6,000 a year from the garage rents and from the 2 storage spaces that we created. And we're getting that extra cash. So when we put this all together, every square foot of that property, if I can turn it into rentable space in some way, I'm going to do that. That conversion costs us about $11,000 with everything that we did on those items. And we've already made 3 times that in the 5 years that we've had it. So you want to look at these things in terms of what is the best, highest and best use of the asset groups, and how can you financially create a financially centric and a tax centric model where you're keeping more of the money and not paying any tax on it or very little tax. And so this is a very, very, very good case study that allows you to see in detail each of these items. Lost my mic there for a minute. Each of these items and how they work. Now we're going to go back in other lessons and courses and go back into these case studies and show you different approaches, different negotiating techniques, buying, different negotiating techniques in selling. How do you leverage the property and sell it for the highest and best use to a potential buyer? What you want to do is model the tax benefits and let the property do all of the talking for you, and let the property sell itself with the tax benefits. Investors that are sophisticated are going to see that immediately, and you're going to get at least 15 to 20% more in value on the property, and probably save twice that amount in the taxes if it's set up right. So anyway, what I want to do is make sure that your takeaway today is these 3 topics: tax savings, increased cash flow, and appreciated value. What is your plan? What does it look like? And if you don't have one, hit the QR code and schedule a free consultation. And let's talk about modeling and what your model would look like. And we can run the numbers, and that's free. That analysis doesn't cost you a dime. It's just a little bit of time, but let's look at the modeling and see where that opportunity and where those hidden opportunities and value are really laying in the property. Now, I want to go back and talk just a little bit and show you the organizational structure, keeping in mind that the bylaws of the corporation need to be modified a little bit, and the operating agreement of the LLC needs to be modified a little bit. And then there are some inter-party or interrelated agreements that we need to draft and create. We have a corporate structure. You are the shareholder, or you and your spouse are the shareholder, and you own the stock of the corporation. 10,000 shares, you have 5, and your spouse has 5, and that equals the 10,000 shares of stock in the corporation. Generally, in most cases, depending on other factors, this would be a C corporation with a calendar year cash basis accounting. You form an LLC that is a managed member LLC. The operating agreement needs to be modified to accommodate about 4 pages of very specific tax code citations and some interrelated material participation language in case you get audited. The operating agreement is set up because the IRS agent's going to want to see a copy of the operating agreement, and they're going to be checking for this. Basically, the corporation would own 10% of the shares of the LLC, and you and your spouse would own 90% of the shares of the LLC. And all of you, the corporation, you and your spouse, are the managing members. Because of the disproportionality allocation rule, the corporation owns 10% of the shares of the LLC, but it's going to get 90% of the income and losses and 90% of the profits and losses and 90% of the gains or losses every month, every quarter, every year. So it's never the LLC. It's going to file a partnership return, but it's never going to have any taxable income. Never. It will never have taxable income. It's going to have a taxable loss, and that's going to pass through to you on a K-1 from the partnership because you, your spouse, and the corporation are all partners in the LLC. You're not subject to the marital joint venture rules because the corporation is not part of your marriage. You don't marry the corporation. You marry your wife or your husband. And so we're not subject to the marital joint venture rules because we've created a different kind of partnership, not a marital partnership. The LLC now owns title to the rental property. I don't necessarily have to sell the rental property. I can sell the shares of the LLC. I don't need to make an asset sale. I can do a stock sale. That gives me a very, very, very different way to do planning. And so you want to be thinking long term. How do I want to have a comfortable retirement where the investments are feeding me and I'm not feeding them and I'm not having to eat cat food because I did a good job in planning my retirement? This is why we're using actual real case studies on all of the properties that Susan and I have to show you the different examples of how this works in each of these examples and case studies and how easy it is for you to set this stuff up. It's not complicated. It's actually pretty simple to set it up, but you've got to pay attention to making sure you define what your objectives are. So the summary for the organizational structure that we want to pay attention to, and your takeaway for today's lesson is the corporation is owned by the investor. That's you and your spouse. The LLC is owned by the investor and the corporation, creating a partnership. So we're going to make an election to treat it as a partnership. The rental property is owned by the LLC. We've done some estate planning. We make sure that in a marriage relationship, that it's husband and wife as community property with rights of survivorship. That way we get 100% step up on the basis if our spouse dies early, sooner rather than later, we're not subject to the 50% step up rule. We get 100% step up. In other words, if you bought the property for $500,000 and it's worth $2 million, the difference of $1.5 million, you only get a 50% step up. If you don't own title to the stock in a certain way, you're going to limit the step up, and then your poor spouse, surviving spouse, is going to have an estate issue and might have an estate tax or a probate issue. And so we want to clean that up and make sure that there's no door that's left open or unlocked that we would have to pay unnecessary tax exposure on. And this is all part of that wealth planning and asset protection planning. This structure gives you the benefits of all of these things without having to pay a bunch of unnecessary fees for that. The needed items that we would want to make sure that we're reviewing and make sure that we've got everything lined up the right way: the corporate bylaws, the LLC operating agreement, making sure all the tax elections were done timely, management agreement between the corporation and the LLC, lease agreement between the LLC and the tenants, determining our holding period and our asset classification, and then finally our asset segregation. At a minimum, for every property that you own, you should have this checklist. At a minimum. There are other things that we can do that are more advanced in terms of self-directed retirement planning, which we'll get into in other courses between now and the end of the year. But for the most part, this is going to keep us sort of fixed on making sure our housekeeping list is not, too terribly long, that we've got basically this checklist, and then we're going to go back and we're going to make sure that we've got this checklist, And then we're going to go back and we're going to make sure that we create the model and the spreadsheet so that we can look at our numbers, and then we can actually find where these opportunities are at and harvest those opportunities or reorganize them. If you don't have it set up, then we can go back and we can do a little bit of what we call reorganization planning, and we can go back and put it in place. You can go back on the cost segregation. If you bought the property 6 or 7 years ago, yeah, we could go back and reset everything from that point. The effect that it has on your tax return, we're not going to recognize any effect until the current year. So you don't have to amend any tax returns. But you probably would want to consider doing that and ask yourself, how is it that you decide how much rent you're charging for your property? If you don't have a scientific based approach, value centric approach to your rent, then you are just guessing, and that certainly is one way to do it, but you're not going to have the property performing as an asset class at its highest and best use for you. Look, the whole purpose of this investment is to work hard so you don't have to. And if it's underperforming, or your asset group is underperforming, your real estate portfolio is underperforming, let's figure out where it's underperforming and why, and let's fix it so that it can perform at the level that it needs to. You've got to take the core inflation rate of the CPI times 2.7, and you've got to stay at that rate for your investments to be performing at that rate or above, or you're not going to keep up with inflation and rising taxes. I mean, the Biden administration, if they get reelected, they're talking about a 44.5% capital gains rate. If that happens, we're going to go from 28.9 to 44.5 in capital gains rates. That's almost double. And then if you're in the state of California, 71 cents of every dollar in profit, or Illinois or New York or New Jersey, 71 cents of every dollar is going to go in tax. Look at Mohawk. We sell it for $2 million. We're not going to have a dime in tax. And they can audit it all day long. And we've been audited before, and we'll still win the audit because we set it up in a way that maximizes those opportunities both today and in the years ahead. Look, at the end of the day, it's your money, it's your investments. But if you don't know what you don't know, this is why you want to attend these lessons, or at least review these lessons, because it's going to give you the tools and the resources. Hit the QR code, get a free consultation. Let's do a free analysis. Let's figure out where you're at. Everything has changed radically in the last 18 months from post-COVID. You should be looking at this stuff on a pretty regular basis, to at least give yourself the peace of mind that you haven't overlooked any opportunity for inefficiency or underperforming in terms of your asset groups, particularly in real estate, because multifamily, I'm telling you, for the next 8 to 10 years is going to be just I've been doing this for over 40 years. I've never seen an opportunity like I see right now. And as fast as we can acquire more real estate, that's what we're doing. And we're helping a lot of clients do the same thing. All right, what I'm going to do is I'm going to stop our screen share. This lesson, an actual updated lesson, will be in the back office later today. This lesson is in there today. But I've got one other spreadsheet that I've added to this, and I'm going to have that sent over to John and have him put that in the back office for you. So you have the most updated version with the other spreadsheet. So with that, today's lesson been kind of fun and exciting. I'll open up for any Q&A right now. In our closing, we got about 5 minutes left for today's lesson, or go more than that if we need to. But if you have any questions, let's go ahead and take a few questions and go from there.
Hey, James, it's Lee. Can you hear me?
Hi, Lee.
Hi. Hey, great lesson today. Really, really informative. You packed it all in. I do have a question about the corporation. And so you said it's maybe better tax-wise to have a C corp rather than an S corp. You know, Ben and I, obviously we have an S corp. So can we use our Day One Media, or do we need to form another, or do we need to reorganize that, or?
Yeah, I've actually worked on some outlines with Alan last month. I did a little bit of an update and to reach out to you. I we want to have we want to keep your S corp in place for other reasons that outweigh the need for another corporation. There's no need for you to have another corporation. This would be a separate division, if you will, of the same corporation. And the S election for other features and benefits that relate to the business side give us more advantage that outweigh the need to bifurcate for the rental property. What I would suggest, though, is that we make the agreement between the LLC and the corporation so that we establish the management conduit, and that we have that management agreement so that we can look at the modeling. Because if you're going to look at a disposition, we want to mitigate any capital gains. And there's some things that we can do right now in terms of that management fee. Basically, that you could get into a zero taxable gain situation with very little reorganization planning necessary.
Okay. Okay. Great. Thank you so much.
Yeah, you bet. John, how about you? I know you're thinking about buying your next deal.
Yeah, I mean this is a good lesson I would imagine a lot of newbies would see this and get a little overwhelmed in terms of the corporate structures, but the way you presented it today was a good way to lay it out and in a way that makes sense to do a structure, you know.
It's a very simple structure conceptually. It
Mhm.
has a little bit of extra moving parts in it, and
Yeah.
there's some extra things that you've got to do in terms of formality of the entity requirements and record keeping and bookkeeping. There's a little bit, but look, at the end of the day, for every dollar you're spending, you're getting 11 to 12, maybe $14 in tax benefits. I would do that all day long. If you told me I need to spend $1,000 and I'm going to save 14 grand by doing it, how often can I do that? Right.
Right.
The biggest
yeah.
opportunity that somebody like you has right now,
Mhm.
and actually for anybody, I would be looking at a 2 to maybe 4 unit building, because under the Fannie Mae and under the Freddie Mac rules, you used to have to come in with 25 to 30% down. So you
Right.
find $1 million property, it's a 4 unit,
Mhm.
250,000 a unit. You got to come in with 25, 30% down. And you can count the rent on 3 of the units if you're going to live in 1 of the units. Well, that's all changed as of November last year.
Yeah.
You now can come in with 5% down. You can count the rent on all of the units. You can count the rent on converting your existing house to a rent.
Yep.
And by modeling this kind of model, working with the lender will be tripping over themselves to loan you the $1 million that you need to buy the property, and you'll have positive cash flow with the tax write-offs that you'll get.
Yep.
That's an opportunity that I think these younger folks need to be looking at in terms of, you're not going to buy your first house. You're going to buy your first property. You're going to live in one and rent out the other 3.
Mhm.
I mean, and the IRS is going to pay 60% in the first 5 years in tax savings of your investment. Why would I not do that?
Well, and above and beyond that, so it's not so much a question as a realization that setting yourself up correctly before you get to that step makes everybody's life easier, including you guys. So, yeah.
Next week is lesson 4, case study 2.
Mm-hmm.
I'll give you a teaser.
All right.
The property next door to Mohawk is a corner property. It was a lot, 2 parcels. It had a house It had an attached garage. It had a detached garage. The attached garage was converted to a studio, and it had an outbuilding.
Mhm.
They wanted 600,000 for the property. We were the third bid in order. There were two bids higher than ours, and they sold it to us for 575,000. We were going to rehab and flip it. And then we talked to the city and we said, well, maybe we'll just build another unit and just add a duplex to it. And the city said, no, you cannot build 2 units on this property. You cannot do that. You're in a transportation corridor. You got the trolley here. You're on a major highway right below. You're 1.5 miles to San Diego State University. You cannot build 2 units. We will let you build 14 units. I put another 50,000 into the property, and I scraped the lot, knocked everything down, got all the permits, all the environmental clearances, packaged it all up, had it sent to a recycling place. Now we have a vacant lot, and we sold it for $1,250,000 cash. It was listed for less than 5 days. We got an all cash offer and closed escrow in less than 30 days. And we have 0 tax liability because Periosea is an LLC that is managed by the corporation, and all of that money and profit went up to the corporation, gave Susan a $250,000 salary and then a matching contribution of $250,000 to her defined benefit plan. I got a $500,000 deduction. I don't have to fund it until October of this year, and I get to claim it on last year's tax return. So I have no tax. In fact, I had a $57,000 loss on the project. And I still got $1,250,000, and we put 500,000 of that in December in NVIDIA stock. And I don't need to tell you where NVIDIA stock is right now, but it's up 175%. And we're getting ready to buy the next product. Look, I'm going to show you how to build wealth and how to keep more of your money and not pay as much tax as you think is necessary if you set things up the right way. Okay. And I'm going to show you in real case studies, real properties that we have bought, real projects that we've done, or projects that we're working on. The challenge is don't overthink the process and don't overcomplicate the simple. Okay, this stuff is not complicated. It's actually pretty simple and pretty straightforward. But if you don't have an investment plan, if you don't have a purpose for which you're buying the real estate, what is its investment purpose? There's 5, and we're going to talk about those next week. If your property is not meeting its investment purpose, let's fix that. Building wealth is not complicated. It's adding more to that which you already have and keeping as much of it as legally possible. You can't do that if you don't have a tax-centric approach to your investments. And so all we're suggesting is if what you're doing isn't giving you the kind of return that it should, then your assets are probably underperforming. And that's something that you can probably adjust or reorganize so that they are performing at the level or above where they should. Your investment should be returning 2.7 times CPI. If they're not giving you that, you're not keeping up with inflation and the rising tax rates. So if CPI, I forget what it came out on Wednesday, it was unchanged. So I think it was like 3.6. If your investments, let's say there's 3.5. If your investments, you take 3.5 times 2.7. If your investments after tax are not yielding the result of that number or higher, you're losing money. you're losing money. And I can tell you, using the rule of 72, how long it will take you to go broke.
Mhm.
You hold it a long time and you're going to go broke sooner rather than later, actually. And it's like rising rents. If you compound the rent increase at 9% after 5 years, your rents actually go up 61% over 5 years because it's compounding. You raise them 9% the first year, now you have a new base. You raise that 9% the second year, now you have a new base. The compounding effect of that means that you've actually got close to 61% in 5 years. In 10 years or less, you're doubling your income. I mean, now your asset is performing at or above the rate that it should perform. This is why I tell people, understand the valuation approach to modeling. Appraisals are important, and I don't underscore their necessity or their importance. You always need to look at appraisals because it tells you sort of where the market's at. At the end of the day, the property is going to sell for what you're willing to sell it for, and somebody's willing to pay for it. But if you don't know what the core value is, then the person buying it, if they're not sophisticated like myself or Susan, they're going to take advantage of that, right? We bought that property, and the reason we got 575 approved is we told a story. We had our broker, Susan's a real estate broker, but we use a buyer's broker in every deal that we've got. And we told this was a family that the person was in dementia and had to be put into a facility. So the kids got the property. And we just said, look, we've been in the neighborhood for several years. We're investors in the neighborhood. We're doing a lot to help improve the neighborhood. We see an opportunity for the property. We own the property next door. We own another one right down the road. And we see an opportunity to improve the neighborhood long range and work with a developer or somebody that will. And we just told that story. And they wanted 600. The reason that we were able to get it for 575 is it was all cash and no conditions, and we promised a 20-day escrow. So they're going to get their money now, not 3 months or 4 months from now. So if you can build a line of credit and you can build cash, and I can give you some negotiating techniques, you can save 15, 20% sometimes on your deal. And you can leverage the deal in a way that is going to give you some huge advantage. If you're going to sell, let's look at the modeling. Let's sell the tax benefits. Let them sell the property for you, because I'm doing a deal right now on a 5-unit for somebody. And anybody that buys this is going to be in a really strong position. We're going to let the tax attributes sell the property. And they're going to get about 22% more than what the listing agent thought it was worth because of that. So it's really an understanding of what your objectives are financially. You have stocks and you have retirement that's probably invested in stocks. These are portfolios. You have real estate. Even if it's your home, it's a portfolio. You have crypto, that's in a portfolio. What are each of these asset groups? What are they performing at in terms of their growth and their return year over year? Are they underperforming? This is focused on real estate. And real estate right now is unparalleled in opportunity, particularly multifamily 2 to 8 units. That is such a sweet spot right now that, I mean, there's such a shortage almost everywhere in this country. And if you can find 2 to 8 units, particularly 2 to 4, and get in with a Freddie Mac, or you only have to live in it for 1 year and a day. And you get to qualify that in a very different way. You let this kind of modeling, your lender will trip over themselves to loan you that $1 million to buy that property. So I'm just saying that there's a different way to look at your investments and a different way to look at your asset groups. If they're not performing at the level that they should by doing a valuation review, or analysis, then let's figure out how to get them up to that level so that you can do more of this. And that's why we do these lessons. Anyway, I'll get off my tangent. Any other questions? Okay, I guess we're all good.
All right.
Have a great week ahead. Next Saturday, same time, same channel, we will do lesson 4. This course has 5 lessons. Thank you very much, Stephen. And we'll have all of those done by the end of June. Then we go into July with the second course on real estate investing principles, where we're going to get into negotiation and buying and selling and holding and looking at opportunities of wealth accumulation. Real estate can represent a large portion of your overall wealth accumulation objective. And it's going to continue to grow and outpace the economy in almost every region of the country. What we're looking at is this shift of population. You have 8 boomers sitting on $110 trillion of wealth, 60% of which is in real estate. Most of it is free and clear or has a mortgage, very little mortgage, with a 3% or lower interest rate on the loan. They are not going to be going out and buying a new property with a 7% interest rate. They're not going to do that. But what we are going to see, and we're already seeing early signs of it, we're going to see a portion of that real estate, I would say probably 150 to maybe even 300 billion over the next couple of years, coming into market. These will be properties that are 2-unit, 3-unit, 4-unit that baby boomers have been holding for 15 years or more, and there's a crap load of it out there. If you can identify those opportunities, you've got some real financial opportunities to pick those properties up in a way that it doesn't matter what they're selling for. If you know how to look at the modeling, just give them what they want and buy it. Because when I show you how to model a 2, 3, 4, 5-unit property with this, you in 5 years, your tax savings will pay for 40% of the property or more, and your appreciated value and free cash flow will give you another 20%. You would be crazy not to buy that property, whatever they're asking. I mean, and unfortunately, a lot of those people are going to be working with real estate agents that don't know what they're doing. And I'm not being judgmental. I'm just saying they just don't know what they don't know. That property has an intrinsic core value that is probably 2 times what they're selling it for. They just don't know what they have. And if you know what to look for, you'll find those deals. Man, I would do anything and everything to get as much cash on the sideline and as much line of credit as possible to buy as many of those as I could get my hands on, because those are going to be huge opportunities for anybody that can see that writing on the wall. I'm going to give you in our next course that starts in July, I'm going to give you a roadmap of how to build a multi-million-dollar real estate portfolio and not pay a dime in tax on it if you set it up the right way, particularly if you can use your Roth conversion rules and some of the things that are going to be able to do that, because all of that asset growth in a Roth is tax-free for life. That means it's tax-free to your estate too. So let's not forget about that. All right. God bless. Have a great day. I look forward to seeing everybody next week on lesson 4, case study number 2. And hit the QR code. Go to our website, smibmanagement.com, and hit the QR code. Get a consultation, free appointment, and let's take a look and see where you're at and what we need to do to get you up to speed. Have a great day. Take care. Thank you.